Hello everyone. Good afternoon. Okay, this is session for financial accounting, and in this session, I suppose we would be good afternoon, Jasleen. In this session, we would be revising company accounts. Any other question that you would like me to focus on? Otherwise, we will be discussing for company accounts today, and we'll revise our presentations on company's account. Happy Navratri. Anyone who would like to ask any question? Okay, now then let's start with our session. Can you see the screen?
Yes, ma'am.
Okay, it's company accounts, right? And on the right, I hope the right screen is visible. Company accounts, balance sheet, assets. So there's a lot to be discussed in company accounts when it comes to company accounts, assets, and other things. I gave it a lot of thought that what should we discuss? Should we start preparing company accounts directly, or balance sheet of company accounts from the trial balance? So we have in the last session we have already discussed the meaning of company. Okay, and that takes us to the next point, that company's account. Before we actually discuss this company's account, we should know one thing, that every company needs to maintain its books of accounts. And can you tell me the place where a company needs to maintain its books of account? Okay, can you tell me? My question is, where should a company maintain its books of accounts? Where and how? Before we actually start with the balance sheet and all that. So according to section, remembering the section name is not important. Section 128 of Companies Act 2013, every company needs to maintain its books of accounts, where it must be there at the registered office. Okay, and how, if it is in e-form, if it is in paper form, well, nowadays we don't have, most of the companies don't have it in paper form. Generally, it is in the form of e-form. So we will be discussing the e-form first. If it's in the e-form, then whatever software they're using, it should be in a position to provide the complete audit trail for each transaction. That means the transaction can be traced back to its origin for whatever transaction it is, or whatever the entry is. It should be in a position that the person who is reviewing or the software should be in a position to give the complete audit trail, all the steps back to the origin of the transaction. That is one thing. If it is in the physical form, then all the documents, supporting documents, and all the ancillary or subsidiary books, every book should be there. Copy of that must be maintained in the registered office. All books of accounts and other relevant books and papers and financial statements for every financial year, which give a true and fair view of the transaction, must be shown. So this is one thing. So another thing is, all the books that the company is keeping must be on which basis? Must be in accrual basis, right? And according to the double entry system. First is on accrual basis, and second is on the basis of double entry system. Ready to move to our presentation, that company accounts balance sheet. Let's move to this. So first of all, whenever there is a company's account, it is divided into the balance sheet is divided into three major components, which can be derived from the accounting equation: assets, liabilities, and then the shareholders funds. Assets are divided into current assets and non-current assets. What do we mean by current assets? First of all, what do we mean by non-current assets? Non-current assets can be further divided into plant, property, and equipment, non-current investments, deferred tax liabilities, long-term loans and advances, and other non-current assets. So first of all, conditions for classification of assets as current assets. When it comes to non-current assets, these are the assets which are going to stay in the balance sheet or are going to be used for more than one accounting period. Then about the conditions, the following conditions, that they are the current assets, those assets are those which we expect to realize or intend for sale within one normal operating cycle of the organization. They are held primarily for the trading purpose, and they are expected to be realized within a year of the reporting date. They are generally cash or cash equivalent. Current assets include all the assets such as inventories and trade receivables. They can be consumed within one operating cycle or 12 months and held primarily for the purpose of trading, right? So what do we mean by operating cycle here? Anyone who would like to give me an example of operating cycle? What is the meaning of operating cycle? We have discussed this before as well. What is operating cycle?
Ma'am, where raw materials are converted into work in progress and then the finished goods. And from the finished goods, we generate the sales. And from the sales, the revenue is generated, which in turn again used for purchasing the raw materials.
Right. So that is operating cycle. So when that means it's an entire process which a company takes in order to convert its cash into short-term assets and then back to into cash, like from raw material to work in progress to finished goods, from finished goods to sales, and then cash again. So taking an example of this, there is one company, Samaya Limited, that provides the following information. So whenever we are talking about operating cycle, we generally take it in terms of time because we are referring to the time period. So raw material stock is held for 4 months. Processing period is 1.56 months. Finished goods stock are held for 5 months, and debtors collection period is 5.5 months. So you're required to calculate or to compute the operating cycle of Samaya Limited. If trade payables are paid in 14 months, whether these should be classified as current liability or non-current liability. Okay, now let's take this thing. Raw material for the in the stock is 4 months. Work in progress is 1.6 months. Finished goods in stocks is 5 months, and debtors collection period is 5 point. That means we have an operating cycle of 16.1 months, which is more than 12 months or 1 year. So this is an operating cycle. Since the trade payables are within the operating cycle, this is to be referred as or classified as current liability. Now tell me, what is the fundamental principle that is driving here? What is that principle which we are using, which compels us to use operating cycle as a measuring scale for current asset or current liability? Here, what we are doing is we are trying to use operating cycle, the time period for operating cycle, as a reference point to decide whether the asset is current asset or a current liability. But what we are actually trying to use is here is the principle that we apply is asset asset liability management. What is that? This asset liability management guides us to use the time period of operating cycle to classify current assets and current liabilities. What is that? That means I have current liabilities which are to be paid back. They must be matched against the assets. And now here we have current liabilities which must be matched against the current assets in order to in order to understand whether the asset liability management is falling within the operating cycle or not. So every company tries to match its assets with the liabilities. And this asset liability management is very much important in order to ensure the solvency as well as the liquidity of a company. If the assets of the company are matched against the liabilities, then what type of assets are matched? So current assets must be matched against the current liabilities in order to have a short-term liquid, in order to have enough short-term liquidity. And along with, if you move further, this also defines how company is managing its working capital. If the current assets are matching the current liabilities, the asset liability management is good, and the company is having a convenient working capital. In case the current assets are not in a position to match the current liabilities, that means the current liabilities are matched against the long-term assets. In that case, the company is following a very aggressive working capital management. So every liability must be matched against the assets that are revolving around in an operating cycle. Then only we will indicate current assets, otherwise current liabilities. Otherwise, they would be referred or classified as current liabilities, non-current liabilities. Now that takes us to the next point, that is plant, property, and equipment. What is plant, property, and equipment? It is basically infrastructure which is used for a business by for using the. It is infrastructure for a business by using their cash so that they can run their operating cycle again. So in order to run the operating cycle, a company requires a number of supporting assets. And the plant, property, and equipment are those supporting assets which are going to reap the economic benefits for more than one accounting year or accounting period. And they are not generally part of the operating cycle. When they are not part of the operating cycle directly, so that means they are not to be recovered within one operating cycle. So that means the company is not raising plant, property, and equipment in order to make sales. So they are not for the purpose of resale, but rather they are for the purpose of generating further saleable goods. Now they can be further classified into tangible assets. What are tangible assets? That means it includes building, land, plant equipment, furniture, fixtures, other things. A reconciliation of gross and net carrying amount of each asset is done at the beginning and end in order to indicate whether there is an addition, disposal, acquisition, or other as adjustments that are related, and in order to decide the depreciation and impairment, losses or reversals. What do we mean by impairment? What is the meaning of impairment? What happens in this case, in case of plant, property, and equipment? In case of tangible assets, a company makes note of the value of the current assets at the beginning and at the end in order to identify what is the difference between these two. If there is a difference, and that difference can be either because of the disposal, acquisition, or maybe because of the decrease in the value that can arise either because of depreciation if it's a normal decrease. Otherwise, it can be because of the impairment loss, that we are recognizing the loss or reduction in the value of an asset. Intangible assets. Intangible assets that do not have any physical existence. They are like goodwill, software, or masthead, publishing titles, mining rights, etc. They are not accepted by lenders as collateral. Why? Uh, because their value. Why we don't accept intangible assets as collateral by lenders? Why they are not accepted? Because of the valuation concerns. Intangible assets are amortized over the useful estimated life, which is amortization is a concept that we use in case of intangible assets in comparison to depreciation. And we have discussed this. Next is capital work in progress. This is related to tangible assets. Cost incurred on constructing fixed assets until the balance sheet. They are known as capital work in progress. Intangible under assets under development are investments that are made in R&D, development, investment is when a company with an intent that it would earn either in the form of interest or dividend. That means other sources of income which a company raises beyond its core business are the non-current investments. And then notes to accounts. Notes to accounts, the details of all non-current investments are shown in the form of land, equipment, building, and whatever non-current investments are. This is to give an idea to the shareholders of what are different sources through which the company is earning its revenue beyond the core business activity. Now, that takes us to when a company offers some particular money in the form of debt to another company or an individual, that is to be, it is known as, in that case, loan is shown as an asset. Obviously, you're extending loan. Okay. The same way, like we take loan, all the details or all the attributes of loan, like the amount of loan, amount to be repaid, number of installments, or any collateral, everything is decided before providing the loan. Okay. Then the notes to accounts are provided as the form of capital advances, security deposits, loans and advances to related parties, other loans and advances, etc. Good. That's about this assets. Now we can move on to the second part. Before we do that, give me give me answer to this question management. Okay, let's check this question and see what your response is. Let's discuss one question. There is a company that has taken a loan for rupees 10 lakh with a term of 5 years. Okay, so the loan of 10 lakh is taken for a term of 5 years and is to be paid 10 equal half yearly installments with interest. First installment is due on and that is of it's 1 lakh. Now tell me how this loan would be classified. Okay, tell me. 25th. 23rd on 30th September 2023, 1 lakh is paid. And how would this loan would be disclosed or disclosure of loan would be on 31st March 2024? This is there is not much of calculation here. All I want to know is how do you see that a company would recognize the liabilities on its balance sheet? So it's about a liability, right? Okay. You need to tell me which thing we will indicate as, I give you a hint on this. You need to tell me what amount you will show as a long-term borrowing and what amount you will show as a short-term borrowing. Very, very simple. And okay, assume, now this is hint 10. Assume operating cycle is 12 months. Okay. And then you tell me how much you'll show as short-term borrowings and how much you would indicate. What that means, what amount you would show as short-term borrowing and what as long-term? So in this case, in this case, we have a loan for 5 years of 10 lakh. Okay, and I show you that we are paying 10 equal half yearly installments with interest. And as it has already been indicated that the first installment is of 1 lakh. So we are not here focusing on any sort of interest calculation. You know that, okay, till we paid 10 lakh, we are ignoring interest here because told us that 10 equal half yearly installment with interest. So we are not focusing on any interest calculation because it said that for the question indicates that the first installment is due on 30th 9 2023 for 1 lakh. If first installment is of 1 lakh, then you have the second installment that is also of 1 lakh. The total installments that you're paying in is 2 lakhs. This 2 lakh you paid within 1 year of taking the loan. Okay, so it will be indicated as short-term borrowing on your balance sheet. Whereas on the other hand, this 8 lakh would be indicated as long-term borrowings. Okay, so that's how we would disclose this liability as 8 lakh as long-term liability and 2 lakh as short-term liability. As nothing was indicated about the operating cycle in this question, so we would make the conventional assumption that operating cycle is of 12 months, and this is how the disclosure would be carried out, right? Now,
Student,
yes.
can we also show it as a current and non-current liability? I mean,
Yes, this is current liability. Under the current liabilities, under the head of current liabilities, short-term borrowings, or we may say short-term loan, 2 lakh rupees, and long non-current liabilities, we will show this as loan or long-term borrowing of 8 lakh outstanding.
okay.
Right. Okay, now if you know this thing, tell me what is your understanding about contingencies under reserves and surpluses? Okay, I give you another question. Tell me whether this question, what is your take on this? So a company is presenting the provisions for contingencies in reserves and surplus. Okay, in notes to accounts. Tell me whether this is correct or not. A company is indicating or showing provisions for contingencies in reserves and surplus, under reserves and surplus in notes to accounts, whether a company should do this or not. What do we mean by reserve? First of all, what is reserve? What is reserve? Reserve and surplus. What do we mean by that? Reserve and surplus indicate that there is some extra fund in the company, either because you earned more profit or you made a sale in which there was some, so, or you kept part of profit for some purpose. So there is a fund that is being created in the company for some specified purpose, and that is indicated as reserves and surplus. Indicated under the heading reserve and surplus. Give me a minute. I need to plug in the charge. Okay. Okay. Now that is the meaning of reserve. Okay. Now what is the meaning of provision? How do we tackle these type of questions? We don't expect you to learn all the regulations for Companies Act and provisions. All we want you to is, if such a situation arises, how your logic should flow. So firstly, you will decide the meaning. You will comment on the meaning of reserves and surplus, and then you will comment on the meaning of provisions for contingencies. What do we mean by provisions? Reserve is something that you have kept as a surplus, right? And whereas what is contingency? Provision. What is the meaning of provision? Okay, now tell me what is the meaning of provision in that context? Okay, provisions. Anyone? Provision is a liability, which you measure because there is some sort of degree of probability. You're providing some provision with or an estimation for a liability. But when you're providing provision for contingency, that means it's a situation which depends on some other. This provision depends on the result of a situation which might or might not happen. So this is of a liability nature. So liability is generally a present obligation which arises because of past events. But when it comes to provision for contingencies, that means we are expecting a result from an event that will happen in future. So based on that, provisions for contingency is actually a is an provision for what do you say? Provision for contingency is result of something that will happen in future. Should we consider this provision for contingency as part of reserves and surplus? What is your logical understanding for this? So reserves is surplus of amount that you have kept. Provision is liability that will happen in future. So reserve was not created for that purpose. So reserves and provisions should be logically kept separately from each other, or should be separated from each other, and that's a reason why they should be kept each other different from kept separate from each other. And if a company is presenting the provisions for contingencies under reserves and surplus in notes to account, what do you think? Is it doing the right thing or wrong thing? What is your point on this after listening to this discussion? Whether it should or should not? Anybody who has responded to this question? Answer is no. the company should not disclose provisions under the reserves and surplus in its notes to accounts. Okay. Now let's move on to the next presentation. Company's account balance sheet assets too. So balance sheet includes current assets. We know in current assets, we have current investments, current inventories. Inventories includes inventory for everything. That is for raw material, work in progress, finished goods, stock in trade, stores and spares, loose goods. Current assets include trade receivables as well. What are trade receivables? What are trade receivables? Trade receivables are those they basically indicate the debtors that we have. Okay, we are going to have them. We made some sort of credit sales and then we are indicating them in trade receivables. Outstanding for more than 6 months should be shown separately. However, these 6 months is to be calculated from the due date of payment. So now my another question to you is, tell me how a company should indicate or show trade receivables at its balance sheet. Okay, let me frame this question in a different manner. There is an disputed trade receivable. Okay, and it is considered doubtful for more than 3 years. Should company show this in its balance sheet as a separate trade receivable, or should it be shown as under the head trade receivables? What is your response to that? Should company show this disputed trade receivable as a separate head under the heading of trade receivable? It should be shown under the head of trade receivables. It should not be shown separate from trade receivables. But under trade receivables, indicated as a separate subheading under trade receivables.
Excuse me, ma'am.
Okay. Cash and cash equivalent.
Hello? Excuse me, ma'am.
Short-term investment and yes.
Ma'am, your voice is.
Yes. Am I audible now? My voice is. Hello. Hello, Vivek. Am I audible now?
Yes, ma'am.
Okay. Probably. Okay. Now, okay, did you get this question? Disputed trade receivables.
Ma'am, it is still breaking out, your voice.
Okay. Did you get this disputed
No,
trade
ma'am.
receivable question?
No, ma'am. No, ma'am.
ये समझ आ गया आपको? My
No, ma'am.
can you repeat me the question which I asked me? Can you tell me what was the question?